going to get into the Silicon Valley Bank drama, and how we're going to approach this is we're going to do a quick down and dirty as to what happened, and then we're going to elaborate on some things and get deeper into the weeds. So if you have a too long didn't read attention span, then stick around for a couple of minutes, and then, well, I guess you don't need to stick around any farther after that. So, Bloomberg Founders Fund, the venture capital fund co-founded by Peter Thiel, has advised companies to pull money from the Silicon Valley Bank amid concerns about its financial stability, according to people familiar with the situation. If you're the type of person who believes in an appeal to authority and that he must know something that no one else does, this is the beginnings of a bank run, as we've seen. The firm told portfolio companies that there was no downside to removing their money from the bank, according to the people who asked not to be identified because the information isn't public. And that is a true statement. There is no downside risk insofar as you, a particular individual agent, unless you're the 20th person in line trying to pull your funds, and due to the homogeny of everyone trying to pull their funds all at once, i.e. a bank run, then there is a problem. So everybody participating in trying to get their money out makes it where people can't get their money out. So there's no downside insofar as you have first mover advantage. Although the bank was increasingly becoming insolvent, it doesn't help when 97% of the depositors have a hair trigger due to being over their FDIC limit and within hours withdrawing $42 billion. The case for insolvency and front-running the concerns becomes a self-fulfilling prophecy, as is the case with bank runs most often. United they stood and divided they fell. If you're going to panic, be the first to panic. So, as rates kept rising, their unrealized losses exploded, as you can see in this chart. When Jerome Powell really started cranking the rate increases, you can see quite the correlation between that and the unrealized losses on Silicon Valley Bank's, assets. So these are some interesting charts that we're not going to get into, but you might want to look into the red highlighted ones if you're concerned of other potential banks engaged in this sort of behavior. So this is a chart, deposits less than $250,000 as a percentage of total deposits. And what you'll see is that SVB Financial Group had 2.7%, which is to say that only 2.7% of their deposits were under that FDIC $250,000 limit. And then you'll see other companies in here that also have been having a very bad week when it comes to the stock market. And like I said, you can look through this chart at your own leisure. We're not going to go through all the names. Then if you look at securities and assets, you'll see that they had 55.4% of their securities or assets as securities. And this is going to matter, and we're going to explain why in a moment. I'm trying to speed all of this up because we have a lot to cover. Plus, as I noted last week and completely failed, these videos are running, longer than people's attention span is willing to allocate. Then, if you are even able to see this, what this is, and this is a pertinent piece of information, is securities maturing or repricing as percentage of assets. And what you see here is that 47.5% of their securities mature later out than 5 years. So maybe we could call that long duration fixed rate assets. And here's a chart of some unrealized losses to total equity. And in case, yet again, you own bank companies and might be interested in such matters. So a variable rate and depleting funding, those are deposits, were used to buy fixed rate long duration assets. Those are the treasuries. All the while being done in a rate raising environment. This is a playbook that hasn't been experienced for decades, especially once you factor in the rate of change of the federal funds rates. That's Jerome Powell, our buddy, cranking up the rates. As deposits, liabilities fall. This is a chart of quarterly changes in deposits. Notice how 2022 you see a withdrawal, not a slowing of increase, not a flatlining, but a negative withdrawal. And then as unrealized losses pile up an insolvency and liquidity risk increases. And the reason being is that many of these are held to maturity securities as opposed to available for sale securities, which we'll get into in a moment. But quickly, what happened to SVB is that much of their securities, as we covered a few charts ago, that 54.5%, the assets are held to maturity, HTM versus AFS, which means that they're not marked to market, which means that if you do have to sell them, then you have to take the hit on selling them. And in large part, that's what happened. So, deposit outflows resolve in one of two ways. This is the crux of the piece. When you have deposit outflows, you resolve it one of two ways. You either sell assets, in this case, treasuries, to reimburse the depositors and to make up for that void of the withdrawn money, or you attempt to raise money via bond or equity issuance. So step one, they did. They sold treasuries. To fund the redemption, Silicon Valley Bank sold on Wednesday $21 billion bond portfolio consisting mostly of U.S. treasuries. The portfolio was yielding it an average of 1.79%, far below the current 10-year treasury yield of around 3.9%. This forced SVB to recognize a $1.8 billion loss, which it needed to fill through a capital raise. Because it's all fine and good because you have the available for sale, and once you burn through that, if the bulk of your assets, your investments, are in HTM, held to maturity securities, which are not marked to market, then you might have, let's just make this a easy example, if you have $10 billion of HTM securities, but their market value has fallen in half, on the books it says $10 billion worth. But if you had to turn around and actually sell them, then you're selling it for $5 billion, which means that you just disappeared 50% or $5 billion. So, with that out of the way, the next step was to raise equity, but that did not work out. SVB announced on Thursday it would sell $2.25 billion in common equity and preferred convertible stock. And those raising efforts collapsed later that day on Thursday. And this is the document. And what it says is liquidity and insolvency. On March 8, 2023, the bank announced a loss of approximately $1.8 billion from a sale of investments, U.S. Treasuries and mortgage-backed securities. On March 8, 2023, the bank's holding company announced it was conducting a capital raise. Despite the bank being in sound financial condition prior to March 9, 2023, investors and depositors reacted by initiating withdrawals of $42 billion in deposits from the bank on March 9th. That's in one day, $42 billion in one day, causing a run on the bank. As of the close of business on March 9th, the bank had a negative cash balance of approximately $958 million. Despite the attempt from the bank, with the assistance of regulators, to transfer collateral from various sources, the bank did not meet its cash letter with the Federal Reserve. The precipitous deposit withdrawal has caused the bank to be incapable of paying its obligations as they come due, and the bank is now insolvent. So off the bank heaven it goes. And it is the second largest one of these that has occurred. SVB scrambled on Friday to find alternative funding, including through a sale of company. Later in the day, however, the Federal Deposit Insurance Corporation, FDIC, then announced that SVB was shut down and placed under its receivership. The FDIC added that it would seek to sell SVB's assets and that future dividend payments may be made to uninsured depositors, which, yet again, may I remind you, is 97% of depositors. Okay, so we're done with part one. That was the quick and dirty of what happened. Now, a lot of people didn't see this coming, but some people did see this coming. So how might one see such a thing coming? Low risk, high quality carry trade that assumed minimum credit risk. But it wasn't the credit default risk which got them, but the duration rate risk that got them. This is page 41. And by the way, the The links will be in the description. Page 41 of Q4 2022 financial highlights published on January 19th of 2023. Now, you need to look at this chart to understand what I'm talking about with a visual aid. On the left side, in 2022, you see all the assets. You have the net loans, you have cash and cash equivalents, you have the AFS, available for sale securities, which are marked to marketed, meaning that you recognize the price that they would sell for, not what you paid for them. Then you have their held to maturity securities, which is a very large part, as we discussed in one of the prior charts. What was it, 54.5%, I believe? The HTM, held to maturity securities, and then the other stuff doesn't matter. So, just imagine a bunch of people want their money all at once. Well, you can't call back the net loans, and the held to maturity securities are supposed to be, well, held to maturity, so you don't really try to liquidate that. So you go into your cash and cash equivalents and your AFS securities. They liquidated those, but that was not enough. And as those beginning charts demonstrated, if you start looking through them, what you'll find out is that SVB's held to maturity securities was a disproportionate amount of its asset portfolio in relationship to many other banks. And this is what put the squeeze on them. So page 85 of the 10K would suggest a good TCE ratio, tangible common equity. And what you would do is you would take the tangible common equity and you would divide it by the tangible assets, and you'd be like, okay, this is a really good ratio. The tangible common equity does not exceed the tangible assets, and it's actually de minimal to the tangible assets, so we must be good to go. So depending upon which one of these you want to look into, the tangible common equity, the first one is 11,880,000,000, and then the second one is 15,196,000,000. But either way, if you then, I don't know what page this is on, but in their 10K, but what you see is, if you look at the bottom, total HTM securities, those are held to maturity securities. And what you find out is, if you look under the unrealized losses column, they have $15 billion, over 15 billion, 15,160,000,000 of unrealized losses, which they don't have to, well, I mean, they account for it as they're accounting for it, but it doesn't make an impactful difference. So what we're concerned about, one of the many things to be concerned about when investing in a bank, is it liquid enough? And as we'll get to later, you really could ask yourself is, how many banks are liquid enough to handle 25%, in SVB's case, $42 billion, 25% of their depositor base withdrawing all their money in one day? And seemingly, I guess, stress tests don't handle this, which begs the question as to what a stress test is. But anyway, so, and the reason people don't pay attention to this is because they're low probability, high magnitude events and occurrences, and most people disproportionately equate those things. So how did this all come about? We'll call this part 3. So in their 10K, they said, much of the recent deposit growth was driven by our clients across all segments obtaining liquidity through, let me give you the quick breakdown. 2020, 2019, 2021, the world was making it rain in cash. Everything was IPOing, rocket ship emojis, bar charts, up and to the right. That was the environment. And all of that allowed tons of cash flow, as the chart we looked at a few ago, when I said you need to pay attention and focus to their assets. On the right-hand side, you'll see how their cash balance drastically increased in the 3-year time span. And that was all that easy money, low credit, rocket ship emoji, degenerate gamblers, staying at home, text the future type stuff. And all of that has changed. So, put more succinctly and articulately, They say that much of the recent deposit growth was driven by our clients across all segments obtaining liquidity through liquidity events such as IPOs, secondary offerings, SPAC fundraising, special purpose acquisition company for those who might not know, venture capital investments, acquisitions, and other fundraising activities, which during 2021 and early 22 were at notably high levels. Though these liquidity events and our deposit growth abated over the course of 22, we were unable to predict whether these liquidity events will return to elevated rates and whether our prior level of deposit growth will return, which is just a phenomenal statement to make, end quote, which is a phenomenal statement to make because they really do not have their pulse on the market, or they're deluded, or they're lying. And I suspect generally it's a combination of malevolence, ignorance, stupidity, and just not wanting to be transparent with people, because the writing was on the wall. And if you got caught off sides, and to say that a high standard deviation bubble event that occurred, we don't know if we'll get back to those levels. You're saying a bubble happened, we're deflating from the bubble, we don't know if we'll get back to bubble territory. I mean, it just seems like a reckless and irresponsible thing to say, if you ask me. So, the failing Ponzi state of unprofitable shitcos caused them to start pulling money out of their accounts. This is my account for it. They went from net depositors to net withdrawers. Why? Because the hype around Silicon Valley has been atrocious. Tech startups, these cash-burning, cashless-generating, constantly digging a deeper hole companies, are essentially long-duration assets. Juxtapose this with the 2019 through 21 era of easy money, low interest rates, ample liquidity, and the ability to dilute the hell out of shareholders and IPO your stock for ridiculous prices. This is the double-edged sword of bubble mania, is in part what ended Silicon Valley Bank. The death knell being poor allocation of capital on the bank's behalf in a rate-raising environment, leading to them to be functionally insolvent and illiquid if they needed to sell their HTM securities. Now, of course, here's the kicker. No one invests in hold to maturity securities thinking they're going to have to liquidate them. But commensurately, you also have to say, how much might we need to liquidate, and why are we investing so heavily in the HTMs? Which I don't know the answers to these questions. I still have questions, so this is not an all-inclusive slide deck of all the information out there. So you have functionally insolvent companies doing business with functionally an insolvent bank. So some closing thoughts. And I touched upon this earlier. Talking trash after the fact is a common bonding experience among people. And they like to poke fun and just talk smack. But let me ask you this. What banks could survive 25% of their deposit base withdrawing their funds in a single day? I get it. It's a level of analysis proposition. Most banks don't put themselves in this sort of pickle to begin with. And it was that perceived pickle that caused the bank run in the first place. So, because most of the time, in most situations, when it comes to bank runs, the perceived FUD, fear, uncertainty, and doubt, is what prompts the subjective emotionalist, which most people are, to make the bank run happen. They would actually remained liquid had people not perceived them to be more illiquid than what they were. So this really is to say that this was all an unforced error among many agents and participants. So it isn't a question of can your bank handle a bank run, but does it conduct itself in a fashion that minimizes the perception of a need for people to engage in a bank run? And not having half your assets in unhedged, long-fixed, durated bonds, and in large part doing business exclusively with cash-burning companies helps, which is where SVB failed. So it's a balance between investing in new age garbage, CRE, commercial real estate, in a rate-raising environment versus shorter duration assets and higher credit rating investments. A miscalculation that SVB won't make again. And by the way, I keep on telling people that you really need to know who you're getting in bed with. You need to know who the management is and where their incentives lie and their track record and history. For instance, during the Bitcoin bubble mania, a lot of people were buying into Mara, ticker symbol MARA. And That's fine and dandy. You understand, Bitcoin's like a third or fourth derivative of liquidity and easy financing. And then to buy a stock engaging in such matters is like a fifth derivative. So that's why there's a lot of leverage and why you can make and or lose a lot of money in Bitcoin or Mara or many of these. But the CEO was a felon. So it's like, okay, like this is a Ponzi pump and dump ran by a felon, which has ridiculous leverage. I'm not saying don't participate in those activities. You can make a lot of money if you know what you're doing, but don't be a useful idiot. Don't delude yourself and know what you're getting into. So here on the left, we have someone who was a managing director at Deutsche Bank in 2008 and led credit ratings in 2007. And there's certain banks that if you're, I don't know, let's just put it like this. There's certain banks that always seem, there's like 5 of them that always pop up every time some kind of a scandal happens. Yeah, everybody got hit in 2008. Okay, fine, fair enough, whatever. But there's certain banks that just time and time again, every scandal that occurs, they seem to be involved. And Deutsche Bank is one of those banks. And they just can't not help themselves. And then on the right, we have an individual who served as the CFO for Lehman Brothers. So the problem with these incidences is that some of these people in SVB are just pawns and they do what they're told, and it's kind of not their fault, and the whole systemic structure of the corporation or the industry is up against them, and they're just trying to pay their bills and go along with it. And I don't know if these people are that or not that, and these kinds of events kind of throws mud on everybody's names, and so it's not necessarily fair, but still, at least be cognizant and aware and properly weigh what businesses and dealings these people have been involved with in the past. Larry Summers, former U.S. Treasury Secretary, in a little speech he gave, said, "I don't think this is a time for moral hazard lectures or for teaching people lessons. We have enough strains and challenges in the economy without adding the collateral consequences of breakdown in an important sector of the economy." But of course, well, I'm not going to, this is running long enough, but I think that's a stupid thing to say. I mean, I get it, but how are people going to learn? And the answer is people don't learn lessons abstractly and intellectually by viewing other people's experiences and learning from historical precedents. People learn through trauma and pain. And I hate to say it, but that's just a fact of the matter and part and parcel of human nature. So the time you teach the lesson is now. And it's not just that, but to quote a very intelligent person, Harris Kupperman, he says, "It's vitally important to ensure that Silicon Valley Bank depositors get stuck in FDIC liquidation purgatory with uncertain recovery. Otherwise, poorly run ship banks will continue to take market share from conservative banks. There needs to be a cost of capital applied to banking deposits." So it's not just a moral hazard. That's a concern among many, because letting Silicon Valley Bank get away with their shenanigans and BS hurts people who are playing by the book, by being proper capital allocators, by people doing the right thing, and as a consequence, not necessarily being able to make as much money, let's say, and by having proper ratios of loans versus available for sale versus held to maturity versus all these other options. So it wouldn't be fair to the industry and the economy as a whole to just let these people get a pass. And we had Putin's price hikes, which is really a scapegoat mechanism, but now we'll call this Putin's panic, because Bill Ackman is such a great individual and is interesting with some of his comments. So SVB Bank, and so this adds more. Let's not put all the blame on SVB, because yet again, they're just one of many moving pieces. SVB failed because Moody's forced the company to do a capital raise at a bad time, Goldman fucked up the marketing of their offering, and SVB clients, that's the venture capitalists and PE firms, and their portfolio companies panicked. And they told other people to panic. And then those other people panicked. It's kind of, you see this time and time again, just like how everybody outsourced their due diligence to Sequoia Capital when it came to FTX. Just like everybody's outsourcing their due diligence and responsibility to VC and PE firms. And with all of that out of the way, I wanted to get that going. And this past week was shit in my portfolio. I'm down, multiple percent. Nothing's looking good. And uranium, a week or two ago, I pointed out the pennant, the flag, I don't know what you want to call it, a year-long triangle thing that's been forming for a year. And that has now broke down on Sprout Physical, or not, I'm sorry, on Sprout Uranium Miners ETF. So I suspect there's going to be more pain ahead for that one for sure. And see what happens. And not much to cover on this note. And this has gone on long enough. Thank you for watching, and until next time.